Fantastic. Okay, right. So it's we're just coming up to 10 a.m. on Monday, the 21st of July, 2014. Hopefully, you guys have all been having smooth sailing in choppy waters, I guess. There's not many other ways to describe how the market's been behaving over the course of the last few weeks. The purpose of this presentation, as usual, is to mark the key levels on our charts where we ought to be looking at initiating trades. And when I'm marking my levels, I'm looking for the black and white areas to be initiating trades from. I like to know the best place to be initiating that long or short trade, and thereby getting the best return on my investment, pulling out as much on the R&R as possible. Before we actually start looking at the charts, it's worth having a quick glimpse at the calendar just to know the key events which are coming up this week, and that will keep us on top of the global economic situation. As it happens, there's not much to highlight on the calendar this week, but during the middle of the week, it will probably start getting a little bit more exciting. On Wednesday, we have Canadian retail sales. We have the release from the Bank of England on their voting pattern from the last meeting. So I guess market participants will be interested to know whether that is changing. So far, although forward guidance, for lack of a better word, has indicated that, interest rates will be rising in the UK, and the governor, Carney, has said that this could happen a lot sooner than what the market expects. As far as the voting pattern is concerned, on the Monetary Policy Committee, we've not really seen a change. It's been pretty much unanimous every month at every single meeting for the last 2 or 3 years almost, right? So no dissenters there. And it'll be interesting to see if some signs of dissent are developing there, i.e. there are members of the MPC who are starting kind of urge, all right, let's do this now. Just something to kind of look out for. Although the key event on Wednesday is not going to be the release from the Bank of England, more likely it will be the release from the Reserve Bank of New Zealand. They're widely expected, and they are the only central bank in the kind of, doing that 90s thing, making the inverted commas with my fingers there. The only central bank in the developed world that is raising interest rates right now. And they're widely expected to take rates up from 3.25% to 3.5%. They've been raising interest rates since the beginning of the year, and they've been hitting a quarter of a percent, 25 basis points pretty much at every meeting. They're widely expected to do the same this time around. As an interesting contradiction or paradox is that whilst they're raising interest rates, they're also expressing concerns about the value of the Kiwi dollar. And, if you're raising interest rates and that swap differential is increasing, you'd expect the value of your currency to appreciate. But they've been raising concerns about that at the same time. So it'll be interesting to see what happens this time around. There might be a shock element. What if they don't raise the interest rates? What if they raise it, but they make an announcement at the press conference that this is the last one and that they won't be raising rates any further. We're nowhere near the historical highs that have been achieved by the Reserve Bank of New Zealand in the past. But what if they announce that they're going to hold it here, and what kind of impact would that have on the Kiwi dollar? So we're going to take a look at the Kiwi dollar in a while. Thursday, flash PMIs out of France and Germany, which is effectively Europe. We also have UK retail sales. UK retail sales is always a good one for a short, sharp shock to the system, and so it might be worth keeping an eye on some of the cable crosses during that announcement. And the week kind of closes with preliminary GDP for the second quarter in the UK. Again, considering the raft of positive data that has been coming out of the UK over the course of pretty much more than a year now, people are going to have quite a lot of expectations on that number. A word of note, there's some poor data last week, and it started creating some volatility spikes on GDP USD in particular, right? So sometimes it only takes, how does it go? It's like one bad apple ruins the barrel or something like that. So again, definitely worth keeping an eye on that one. Otherwise, the general sentiment in the market right now seems to be slow and steady as you go. If you're looking at price behavior over the course of pretty much the whole year, and so you have to bear that in mind too. And we bear that in mind because of targets. So right now we're not initiating trades imagining that we're going to be pulling 400-500 pip swings. We'd rather imagine 40 or 40, 30 even. I'll start at 30, 30, 40 or 50 pips in the first instance, and then after that, if the price is able to swing a little bit further, we're just kind of grateful for the opportunity to be in that type of trade. All right, enough of my ranting about the economic calendar. It doesn't really matter that much. Like I said, it's just useful to know when those events are coming in case you get the volatility spikes. Let's turn our attention towards the charts. First up this morning, we're looking at Euro USD. The charts right now, as far as the technicals are concerned, are very clearly in two brackets, and it's the easy to read versus the not so easy to read from a structural point of view. So we'll look at some of the easier reads this morning, and if I'm up to it by the end of having gone through the easy read, we might try and decipher some of the stuff which is not so easy, although there'll be little point in that, because if it's not easy to read, it's not going to be easy to trade either, right? But if we have time, then there might be some nuggets in there somewhere. All right, so first off, the Euro USD. We've been discussing Euro USD for quite a while, and as far as the general sentiment is concerned, we've considered the sentiment to be determined on this particular instrument just by the yearly open price. So the yearly open price here is at the 37.80, 37.90 price handle, and we've always said so long as the price is above that, then you ought to be buying, and if the price is below that, you ought to be selling. If you're zooming out, if you're zooming out on this particular instrument, then you can see, as far as the year is concerned, we've spent a little bit of time above the year. Equally, we've spent some time below the year, but doesn't seem to be headed anywhere in a rush. Right? She's not in a mad rush to go anywhere. Since January, we've managed 200 pips above the yearly open, and talking about 300 pips below the yearly open, and she's just off the yearly lows at the moment. So she's not going anywhere very, very fast. And what it means is that, you know, we might have technical calls for entry, but you just have to bear that volatility in mind, keep that volatility in mind. I think volatility, the non-existence of volatility on this instrument, you have to kind of keep that in mind. And so again, you know, as long as we've got a technical, I'm prepared to play it. But what I don't want to be doing is to be imagining right now that she's going to be hundreds of pips higher or hundreds of pips lower. You're just going to kind of take it as it comes. Follow the hourlies, follow the 4 hourly bars. You know, once you're in that trade, and just take it to its logical conclusion. When the money's there, bank it, and then just wait for the next setup. All right. As far as the near term is concerned, a few levels to look out for. We were talking the Euro USD last week. You were following the trade notes. She broke down, and so the area that I'm looking at right now is just this block here. Right, so it's this block here, and that extends from about 35.70 to about 35.90. So I would expect failure just below the 36 price handle. That's the kind of technical play which is going on here. Any kind of push towards that 36 price handle, you'd look for failure there, and then continuation to the downside. So as far as I'm concerned, on this instrument, bearish sentiment is being defined by the 36 price handle in the near term. So long as the price is able to remain below the 36, then I will continue to maintain near-term bearish bias on this particular instrument. As far as the strategic play is concerned right now, a pullback to 36, I wouldn't necessarily be selling that. Rather, what I would be looking for is a pullback to the 36, and then for the price to collapse from there. And once the price has made it below 35.20, that is where the market opened this week. Once the price has made it below 35.20, after failing at 36 handle, that would be the point at which I become interested in actually initiating the trade. The reason for that is that actually what I want to be doing is to be trading the direction of the week. So if the week is looking bullish, what that means is that the price is above the weekly open, then I don't want to be necessarily fighting the direction of the week at that time. The reason is that, you know, she could equally push towards the 36, make a reaction, and then end up breaking through it, and I'd have to cover that position very, very quickly. However, once the price has changed, or the direction of the weekly candle has changed bearish, then at that point it would be kind of logical, reasonable, rational to expect for further expansion in that direction, right? So it's you know, there's bearish sentiment there. We believe at the moment, based on the current price structure, that we should get a follow through to the downside in this instrument, but the ideal trigger for that would be pullback to 36, failure at 36, and then the price falling below the 35.20 handle. Maybe a 4-hour close below 35.20. That would probably become the appropriate trigger if the price plays out in that manner, and then we can look for further expansion to the downside on this particular instrument. I'm going to show you maybe some of the reasons for caution on this instrument, and The reason for that caution is just that there is some support here, where the price is right now, right? So there's reason why the price would stall here, and so you can kind of see there's a little hook there, support. Why to believe that that is going to be breached? It would not be unreasonable to expect some element of bounce there, and so that is the reason for the cautionary tale. Yep, she is heading down. If I'm doing anything, I'm actually looking to buy. I'd rather look to be selling as far as the structural situation is concerned. But I don't want to be selling while she's sitting on that support, because if it does end up holding, I could find myself on the wrong side of it very, very quickly. If you're looking at the daily, YAM has something like this, right? So again, there's a long-term trend line here. Trend lines do get breached, right? Okay, it's not a particular problem, but if I'm trading the trend line breach, I'd rather have that breached first. Right? So just these two walls, they cause for concern, and I'd be trading quite cautiously at this particular level, although the bearish sentiment as far as the direction of the year is concerned, very much intact. All right, let's take a look at GBP JPY. Okie dokie. Right, one moment. Let's just have a look. We look at the G's here, right? So this is cheating for me a little bit with GBP JPY, but it's cheating because I'm going to present someone else's analysis. A friend of mine, colleague, was charting Friday. He actually sent it to me before the price reacted at that level. Right? So, if you want to do it like that, you can do it off the hook there. And then we adjust it to that level, right? So, in fact, I'll just mark both in the chart. All right, so we have a little bit of a support resistance wall going on. I want to present you something that you can maybe do something with in the near term. Right, so this is GBP JPY, and there's a resistance wall. So as far as the trade is concerned, you've got support, and you have resistance. The expectation is that you pull back towards that wall, you short the underside, and the risk of taking the trade at that wall is marginal. It's relatively insignificant. I think if you're using GBP JPY, using a 35-foot stop, and you're trading the strike of the underside of that wall, after that, if she moves even 15, 20 bits against you, you kind of know you're wrong, right? So I think it's going to make a good intraday reaction level. Certainly worth having it marked on your chart, right? So that's the GBP JPY. It's a support resistance wall, and I expect for the price to be held after a strike on the underside of the wall. If you're looking at the wider time frame on GBP JPY, there is there is some potential here for some form of broadening structure. Right? So I'm seeing something like this. Right? There's potentially some kind of broadening structure maybe forming here on GBP JPY. And if that is the case, then it may not be unreasonable for the expected price to do something like this. Okay, so still take into account what I said at the beginning of the presentation, right? You know, you're looking at 30, 40, 50 in the first instance. If she does go a little bit further than that, then it's just your good fortune, I guess, more than anything else, right? But it's an intraday reaction level, and I'd expect that to hold on a strike on the underside. Okay, let's take a look at the Euro GBP. In fact, before we go to Euro GBP, just something which is worth noting is what's happening with the yen crosses generally, right? So this is the GBP JPY, and we're up at the 173 handle. As a note, the yearly open on GBP JPY was at 74.40-ish. So we're just off of that yearly open price on this particular instrument, right? She did fall at the beginning of the year. She's been as far as 1,000 pips below that yearly open price. So it's just interesting to see that she's back up there. She's at the yearly open and near enough the yearly highs. And there's the new kind of yearly high set a couple of weeks ago at the 75.30 price handles, that 75 price handle. But if we're looking at USD JPY, we're about 400 odd pips below the yearly open, but at the yearly lows, right? We're at the yearly lows. And if we're looking at Euro JPY, again, about 800 pips below the yearly open at the yearly lows. What that tells me is that what's happening here with the yen crosses against the major, so you get the USD JPY, GBP JPY, Euro JPY, is that this is no longer a yen story. So, pretty much the whole of last year, the beginning of this year, it was a yen story. We knew it was a yen story because all of these crosses were moving together. They were moving higher together, they were moving lower together. What we've got at the moment is Euro JPY reflecting European fundamentals, GBP JPY reflecting UK fundamentals, and USD JPY being as popular or unpopular as the dollar gets, and it kind of comes in and out of fashion. But certainly a divergence between GBP JPY and what's happening with USD JPY and Euro JPY. So the expectation would be, and this is a kind of very general expectation, is that at some point, there has to be a realignment in what's happening here, right? I would think that the Euro JPY, it either has to catch up with GBP JPY, right? The Euro yen has to catch up with pound yen, go back to those yearly highs, which in this instance would be at the 45, 46 price handle. So, we're talking a good 800-900 pips here on the Euro yen. And In the near term, she just seems to be, there is a support which is established, right? So, be interesting to see exactly how this plays. The alternative is that maybe GBP, JPY, it catches up with what's happening on the other crosses, right? So maybe there's a big collapse coming in this particular instrument. When it comes to conspiracy theories like this, this doesn't necessarily fit into the bracket of what would be called technical analysis. Maybe it's a little bit more conspiracy theory than technical analysis. And, you can never say anything about the timing here either, right? So, GBP, JPY is on a breakout. There's no reason why that can't continue for any length of time. But at some point, we would expect for these pairs to realign, and start seeing strength and weakness in the yen crosses at the same time, right? So just something to kind of look at, or maybe something to think about, right? It's like I said, can't say anything about timing. She could, GBP, JPY should carry on breaking more, carry on doing that while the Euro JPY remains stagnant. But at some point, they would realign, and you'd see either a sharp fall in GBP, JPY or a sharp rise in Euro Yen, right? But you never know. You might see a sharp rise in both or a sharp fall in both. I think I've covered every practical scenario there, right? She's either going up or down, right? Okay, but just something to kind of be aware of. I find it quite interesting when you get that kind of divergence on the crosses. It is something I've seen before, and in fact, what I'll do later on today is I'll bring up those charts. It's going back maybe a year or two, Euro AUD and GBP AUD, where we saw a huge amount of weakness in Euro AUD, but GBP AUD was pretty much holding her own at that time, and within the space of a couple of months, there was a very sharp realignment on those two crosses. So I'll find those charts and I'll post them up on my website for you guys to have a look at it, and maybe the idea of what I'm talking about might become a little bit clearer, right, as far as price expectation is concerned. All right, let's move on with this and take a look at the Euro GBP. Euro GBP, it is officially recognized as the most trending forex pair. If you kind of zoom out on this and please go to the daily chart, something like that. When she's going up, she's kind of clearly going up, and when she's going down, she's clearly going down. As far as the current price structure is concerned, there's a very clear bearish momentum on this particular instrument, not just from sentiment perspective. The sentiment is kind of very visible here, but if you are tracing the instrument structurally, she's been falling, making resistance, and she continues to kind of make resistance as she falls. I'm interested in a counter trend trade on the Euro GBP. I'm finding it a little bit easier to fathom the idea at the moment. I'm just finding it a little bit easier to digest the idea of a counter trend trade on the Euro GBP, but it has a very particular trigger, right? So what matters is the actual trigger that would allow me to initiate that trade. And what I'm doing is I'm looking at the nearest resistance area. The nearest resistance area is here. It's being defined by this particular price cluster. So that's in the kind of 79.50, 79.60 area, maybe extending all the way up to that 79.80. And what we've seen is a resistance being established here, right? So it's very clearly established as resistance. The price expectation would be that anytime the price goes and hits that block, the price should be rejected from there, and therefore in the near term, the bearish sentiment is being defined by that resistance block. So long as the price remains below that block, then from a technical perspective, the bearish sentiment on this instrument remains intact. I'm interested in actually buying the Euro GBP. So my trigger is a breach of that resistance, and not just a breach of that resistance, but what I actually want to see is a significant breach of the resistance, right? So a significant breach, maybe even pushing as far as 80.40. So anywhere between a 70 and 100 pip move through that block, and then because it has been resistance, at that point on a pullback toward this block, I would like to see this block then support, and I would be buying inside of this block with my stop marginally below it, looking for a reversal trade here, right? So long Euro GBP, but there's a trigger there. It's a very well-defined price action trigger. I'm looking for a support resistance flip, or in this instance, a resistance to support flip, right? So I'm looking for resistance and support. And if it happens that we get that SR flip here, then I think that this pair has significant potential to the upside. In the first instance, I'd probably be looking somewhere around there, right? So pushing up towards the 82 price handle, I don't think that would be unreasonable. And if she does make 82, then it would not be unreasonable to imagine 88, right? So, considering the kind of strength that we've seen on the pound of late, it might sound a little bit crazy, but, stranger things have been known to happen. What matters here more than anything else is the trigger. I think that's the key issue here, really. So, if it happens that I get that trigger, I take the trade. If there's no trigger, then I'm quite happy to be sitting aside on this, right? There's no desperation here to be initiating. There's no desperation here to be initiating that particular trade, right? So as long as the trigger is there, I'll take it. If it doesn't happen, it doesn't happen, and that's okay too. Right, just a couple more to look at. First up, a couple more to look at. The first out of those two is the Kiwi dollar, right? So, Reserve Bank of New Zealand decision on tap, that's happening on Wednesday. I discussed a couple of scenarios at the beginning of this presentation about that in terms of what to expect from the Reserve Bank. The general agreement, the general consensus seems to be that there is likely to be another rate rise from the Reserve Bank at this Wednesday's meeting, and that's okay. You've got to listen in to the press conference, or certainly read the press release that follows that. And, as I mentioned before, the Reserve Bank practically at every meeting where they raise the rates and express concerns about the value of the Kiwi dollar, and effectively they are trying to kind of talk it down, and even gone as far as saying that it's kind of untenable for the Kiwi to hold at these kinds of levels. I don't find myself fighting the central bank. The swap differential if you're buying the Kiwi is pretty good, but you don't want to find yourself fighting the central bank. So I like the idea at the moment about shorting the Kiwi dollar. At the same time, I want to make sure that I have a good trigger. I want to make sure that I get a tight entry. I don't want to be randomly shorting the instrument and then paying that swap differential, paying the tariff effectively, paying a rollover every single day while I'm holding that short position. Rather, I want to initiate short and find that it's going into the money very, very quickly. If it can do that, then I'm a happy trader. I'm a happy trader. If it can't do that, then I'm in trouble. And I want to be out of that position. So my expectation is that last week we saw starting to break down a little bit, right? So there's a little kind of channel that she was moving in there, and we've seen that channel break down. I've marked a couple of different areas where I think that the wall may be, right? So something going from support to support and something going from support to resistance. Both of them seem feasible, but I like the upper wall, right? And so what I'm going to be looking for is that if on Wednesday we get a sharp spike up to that wall, right? I would like to sell that wall. I'd like to sell it. And I don't think that I need to risk very much on selling that wall. Probably not more than 30, 35 pips, right? And I would sell that wall. And I would look for that to move into the money very, very quickly, right? So again, it's support resistance. You could sell that wall at any time, but I think it would be particularly fruitful if on that news announcement we're getting a strong spike, right? If we're in a strong spike up to the underside of that wall, I think it would be a very, very good time to sell it. And then look for a collapse in the price of Kiwi dollar. Remember, from the news aspect, it's the volatility that is mattering to us. But if they announce, if they don't raise rates, that there's going to be some shock value in that, right? They've done it at every single meeting this whole year. So if they don't this time around, there'll be some shock value in that. If they do, but they say it's the last one, right? If they do and they don't mention the currency and they don't say it's the last one, then we might find ourselves in trouble. But nevertheless, if I'm shorting her, that is the place where I'd be doing it from, right? I think that that is where I would get the best risk definition, and to the downside, she could go deep. She could go deep. Maybe she's overdue a significant correction. She's overdue a significant correction. So it could go quite deep. If you're looking to kind of line up your lines, you might also be interested in marking something like this. You can also mark something like that. Right. So a little bit of a channel formed here before it collapsed. I'm charting for shorts on this. I'm just looking for an excuse, for a reason, right? But the wall that I showed you, that's the one. That's the one. I think that would be the most opportune place in order to be initiating a short trade. All right, last up this morning, CAD CHF, right? So pretty much since the end of the first quarter, in fact, so from March of this year, right? From March of this year, Canadian CHF, very strong rally there, right? I'd like to say secular, but it's almost secular, right? She's really only moving in one direction. Um, and so this started off at 78 price handle. We're now at 83, but like 500 pip rally over the uh, uh, from the low to the high since March, right? It's quite a significant move. Um, but maybe there is cause or reason to believe that that would be coming to an end now, right? So I draw my wall, something like this, and that's my wall, and my expectation is uh, that I would expect for the price to be rejected on every subsequent strike on the underside of this wall, right? So any strike on the underside of the wall, I would expect the price to be rejected. And so I think there is good cause. There's good cause to be actually shorting the instrument on the underside of that wall. And that first strike, uh, it gave a reasonable reaction considering the general volatility on this pair. Like so, 130 pips there. Expect the same on every subsequent strike. In the near term, what I've been thinking is that are we going to get an intermediate high here, right? So is there like a medium term high here on the CAD Swissy? If that is the case, then it may be worth actually charting the instrument for the short trades. Maybe worth charting the instrument for the short trades. So I would be looking at doing something like this maybe. Right. Okay, so there's the wall. Quite a clean support resistance wall here. And considering that she's already had a second strike here, you might want to initiate a short play in defense of that high, just looking for the price to collapse and maybe another test of that 82.80 price handle, right? But certainly if she goes up there a third time, it's a clear it's as clear a technical trigger as you're ever likely to get on any pair. A very clean wall. I like it, right? So I'll be looking short the instrument given the opportunity. And I'm not against the idea of shorting at market either, just in defense of that high. She may not go for another tax. It's just a question of whether you like the risk definition, which at the current price isn't that significant, right? You'd be risking about 25 to 30 pips, right? So certainly worth looking at, but mark the longer term wall, mark that longer term wall. If she does ever push back up there, I think you are going to see very clean reactions on the underside of that wall. And it makes a very good explanation about why the price stalled there, right? It makes a very good explanation about why the price stalled there. Once you found an explanation like that, determining a reversal or even a swing reversal, not out of the question, not out of the question. If she does turn from there, she spent most of this year below that yearly open. If she does if she does turn from here, it would not be an unreasonable expectation to be developing. Okie dokie, folks, that's your lot. That's everything that I wanted to be discussing and sharing with you this week. So just have a quick look. I don't think there are any questions, which means we're pretty much done. All that remains to be said is to thank you guys for attending. If you like what you've heard and you'd like a little bit more of it, do check out my website. I publish my analysis every week on my website, including trade alerts and updates as the price action develops. It's an invaluable resource for every level of trader. And if you're really looking to take the game to the next level, I think you've got to be looking in at some of these services which I provide. I'll be back here in a couple of weeks' time, back in the first week of August. So I'll see you all again then. Thanks as well to the team at FX Street. So till then, have a good one, and see you all in a few weeks' time. Thanks, fellas. Bye.